Imagine waking up at 40 years old with complete financial freedom. Your house is paid off or close to it, your investment accounts have grown into 7 figures, and work has become a choice instead of a necessity. Now imagine another person the same age who earns a decent salary but still lives paycheck to paycheck, struggles with debt, and wonders where all the money went. The biggest difference between these two people usually isn't intelligence, luck, or even income. It's the financial decisions they made in their 20s. Most people believe wealth is built by earning a huge salary, but in reality, wealth is built by mastering habits that allow money to grow over decades. Your 20s are the single most powerful decade for building long-term wealth because time is the one asset that money can't buy. In today's video, we're going to break down exactly how people in their 20s can build real wealth using proven financial principles, smart investing strategies, and disciplined money management that can completely change the trajectory of their lives. One of the biggest financial myths is that you need to be rich before you start investing. That's simply not true. Wealth isn't created by having money. It's created by consistently putting money to work. Thanks to compound growth, even relatively small investments made early can become enormous over several decades. Someone who invests a few $100s every month beginning at age 22 often ends up with significantly more money than someone who waits until their 30s, even if the second person invests much larger amounts. Time is the secret ingredient that makes investing so powerful. Every year your investments generate returns, and then those returns begin generating returns of their own. This snowball effect becomes stronger with every passing year, which is why starting early is far more important than starting with a large amount of money. Before investing even a single dollar, your financial foundation needs to be strong. That starts with budgeting. Many people dislike the word budget because it sounds restrictive, but a budget is actually a plan that gives your money direction instead of letting it disappear without explanation. Every paycheck should have a purpose. Your essential expenses should come first, followed by savings and investing, and finally discretionary spending. One of the simplest habits that wealthy people practice is paying themselves first. Instead of waiting to see what's left over at the end of the month, they automatically transfer money into savings and investment accounts as soon as they get paid. Whatever remains becomes their spending money. This small shift completely changes your financial future because saving becomes automatic instead of optional. An emergency fund is another critical building block. Life is unpredictable. Cars break down, medical bills appear unexpectedly, jobs are lost, and emergencies happen when you least expect them. Without an emergency fund, many people rely on high-interest credit cards, creating debt that becomes difficult to escape. Financial experts generally recommend saving 3 to 6 months of living expenses in a high-yield savings account. This money isn't an investment designed to generate high returns. It's financial protection that prevents temporary setbacks from becoming long-term financial disasters. Speaking of debt, not all debt is created equal. High-interest consumer debt is one of the biggest obstacles to building wealth. Credit card interest rates can exceed 20%, making it nearly impossible for investments to outperform the cost of carrying that debt. Before aggressively investing, eliminating expensive debt should become a priority. Student loans and mortgages may have lower interest rates, making them more manageable, but high-interest revolving debt acts like a financial anchor that slows down every step toward financial independence. Your credit score also matters far more than many young adults realize. In the United States, your FICO score influences your ability to qualify for mortgages, auto loans, apartments, insurance rates, and sometimes even employment opportunities. Building excellent credit starts with simple habits like paying every bill on time, keeping credit utilization low, avoiding unnecessary debt, and maintaining older credit accounts whenever possible. A strong credit profile doesn't make you wealthy by itself, but it reduces borrowing costs and opens financial opportunities throughout your life. Now let's talk about income, because wealth creation isn't just about saving money. It's also about increasing your earning potential. Your 20s are the ideal decade to invest in yourself. Learning valuable skills often produces the highest return on investment you'll ever experience. Whether it's software engineering, digital marketing, artificial intelligence, cybersecurity, sales, finance, healthcare, or skilled trades, developing expertise allows your income to grow much faster than inflation. Every raise, promotion, certification, or new opportunity increases the amount you can invest, creating a cycle where higher earnings accelerate wealth creation. Another powerful strategy is creating multiple income streams. Relying entirely on one paycheck increases financial risk. Many financially successful people begin side businesses, freelance online, create digital products, invest in real estate, consult within their industries, or earn advertising revenue through online content. The goal isn't to work endlessly. The goal is to diversify your income so that your financial future doesn't depend on a single employer. Even a modest side income invested consistently can produce remarkable long-term results. Once your financial foundation is secure, investing becomes the engine that builds wealth. Many beginners believe investing requires picking individual stocks, predicting market crashes, or constantly watching financial news. In reality, most successful long-term investors keep things surprisingly simple. Broad market index funds and ETFs provide exposure to hundreds of companies through a single investment. Instead of betting on one business succeeding, you're investing in the growth of the overall economy. Historically, diversified investments tracking major indexes like the S&P 500 have delivered attractive long-term returns despite short-term market volatility. If your employer offers a 401k, take advantage of it as early as possible, especially if the company provides matching contributions. Employer matching is essentially free money that immediately increases your investment returns. Walking away from a company match is like refusing part of your salary. As your investments grow, consider whether contributing to a Roth IRA or traditional IRA makes sense based on your income, tax situation, and long-term retirement goals. Understanding the differences between these accounts can help maximize tax advantages while building retirement wealth. It's also important to stay informed about annual contribution limits established by the IRS so you can take full advantage of available tax benefits. One mistake many new investors make is trying to time the market. They wait for the perfect opportunity, hoping to buy at the absolute bottom. Unfortunately, nobody consistently predicts market movements, including many professional investors. Instead of waiting for perfect timing, focus on consistency. Investing a fixed amount every month regardless of market conditions allows you to purchase more shares when prices fall and fewer shares when prices rise. This disciplined approach removes emotion from investing and has historically rewarded patient investors over long periods. Lifestyle inflation is another silent wealth killer. As income increases, many people immediately upgrade their apartments, cars, vacations, and shopping habits. While enjoying your success is important, spending every raise prevents wealth from growing. One of the smartest habits is increasing your investments every time your salary increases. If you receive a 5% raise, consider investing most of that additional income before adjusting your lifestyle. This allows your quality of life to improve gradually while your investment portfolio grows much faster. Taxes are another important piece of the wealth-building puzzle. Understanding basic tax planning can help you keep more of what you earn. Tax-advantaged accounts like 401ks, Roth IRAs, health savings accounts, and certain employer benefits allow your money to grow more efficiently. While everyone's financial situation is different, learning how taxes affect investing, capital gains, dividends, and retirement planning provides a meaningful advantage over the long term. Building wealth also requires protecting it. Insurance may not be exciting, but adequate health insurance, renter's insurance, homeowner's insurance, auto insurance, and disability coverage can prevent a single unexpected event from destroying years of financial progress. Financial planning isn't only about growing assets, it's also about reducing risks that could erase them. Perhaps the most overlooked factor in building wealth is mindset. Social media constantly encourages people to compare themselves with others who appear to have luxury lifestyles, expensive cars, designer clothes, and exotic vacations. What those platforms rarely show are credit card balances, personal loans, financial stress, or lack of savings. Real wealth is often quiet. It's reflected in growing investment accounts, low debt, financial flexibility, and peace of mind rather than flashy purchases. The wealthiest individuals frequently prioritize ownership over appearance, choosing assets that appreciate instead of liabilities that lose value. Patience is ultimately the greatest competitive advantage in personal finance. Markets will rise and fall. Economic recessions will happen. Headlines will predict financial disasters. Through every cycle, disciplined investors who continue saving, investing, and focusing on long-term goals consistently outperform those who react emotionally to short-term events. Building wealth is rarely exciting on a daily basis, but over decades, the results can become extraordinary. If you're in your 20s today, you possess something more valuable than a high salary, a business empire, or even a large inheritance. You possess time. Every smart financial decision you make today has decades to compound into something remarkable. Start with a budget. Build your emergency fund. Eliminate high-interest debt. Strengthen your FICO score. Invest consistently through your 401(k) IRA and diversified index funds. Increase your income by developing valuable skills, avoid lifestyle inflation, and let patience work in your favor. Wealth isn't built overnight, and it doesn't require perfection. It requires consistency. The choices you make over the next few years can shape the next 40 years of your life, and the best time to begin building that future is not someday, not next year, but today.